Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we have a very timely topic for me about how to trade bullish and bearish markets utilizing options. And I really like talking about this topic because it really allows us to take advantage of one of the most beneficial parts of options trading, which is being able to take a directional view on the markets. So whether you're bullish or bearish on a stock or ETF, but being able to do so with leverage, but also with limited risk. So today what I want to do is I want to explore the different strategies that you can utilize to trade these types of markets, whether you have a bullish or bearish view, and be able to do it in a way that has limited risk. That's really one of the things that we're after whenever we're trading options. So today I want to break down some of the basic strategies around taking a position in a bullish or bearish market, and then show you, more importantly, how these options actually behave when the markets go higher as you expect it to, or if the markets go against you, what can you expect? Now, it's also important to understand the difference between trading a stock and an option, and what is the actual trade-off that you have when you're trading stocks versus options. So I want to try to illustrate as much of that as possible, break down the basics of these types of strategies so that you can understand how calls and puts work. We'll also talk a little bit about a more advanced strategy, but today this is just more of a primer helping you guys get up to speed, and then we will have further educational events to help you learn more about those more advanced strategies. Now, before I go ahead and get started, just a quick disclaimer: what we're discussing here today is only for educational purposes. They are not a solicitation or offer to buy or sell any specific securities. And for those of you that are brand new to options trading, I just want to say that if you're new to options trading, this is something that doesn't, we don't expect you to be able to learn how to trade options just by watching a single webinar. It is something that takes time to learn. And that's why here at Options Play and NASDAQ, we've dedicated to doing ongoing education for you. So you have free access to the tools that I'll show you here today. Not only do you have access to the Options Play platform, which I will show you on our webinar today, you also have access to free options education webinars, just like the one you're on today. And we do this every couple of weeks so that you can come back and have continuing education to help you learn how to trade these types of strategies. And more importantly, we want to show you the tools that you have access to free of charge in NASDAQ, in the Nordics, that allow you to actually apply what you've learned here today. And I'll teach you on those platforms. So after you finish here today, you'll be able to log in and immediately see how to utilize those tools. So for those of you that don't already have access to Options Play, you can sign up using the link on your screen, which I just posted into the chat window. For those of you that are watching from home, if you could bring up your chat window, which is at the bottom of your screen, and just please type yes into the chat window if you've already signed up for Options Play. If you have not signed up for Options Play, please type no. I just want to get a sense for the audience here in the room. How many of you are already applied for an Options Play account, and how many of you are brand new? Okay, so for the few of you that said you have not registered for an account yet, I highly recommend that you do, because you get access to the education, you get access to the weekly cover call and short put reports that we send out Monday morning, you get access to the education and the platform, and it's all free of charge to you using that link on your screen. And I just also one other news announcement. It's this upcoming Thursday, December 10th. I'm actually going to be in Stockholm. We'll be doing an event on Thursday from 5:30 to 7:30 p.m. It's a free event to help you learn how to trade options. It's a 2-hour event. I, myself, and a few other people from the exchange will be speaking. I'll be giving a demonstration of Options Play. There will be another investor there, institutional investor there, and he'll talk a little bit about how he utilizes options, and then we'll have a little Q&A to allow you guys to come and ask us any questions you have regarding options. So you can register for this event also free of charge. I just sent the link to everyone in the chat window. For those of you that are interested in learning more, I hope to see you there next Thursday. So let's go ahead and jump in. But before I do, I just want to ask the audience here a couple of questions. And this is going to help us just better understand the audience here. So I have a poll on the screen, and I want to understand what are your options. What is your options trading experience? Are you brand new to options trading? Are you currently learning? Do you have some experience trading options? If you could please answer the poll on your screen, that would really help us frame the topics today, as well as our ongoing education going forward. There was one question about how advanced will the Learn to Trade Options event be. It will be pretty basic, I will say. I don't think we're going to get into anything advanced. It's more of showing you the tools. We're not going to get too far into the option strategies themselves. It's more of a discussion around options trading and the tools that are available to you. Okay, great. So it looks like about 2/3 of you have already voted. Perfect. Looks like more than half of you have some experience trading options, which is great. The other third of you are either brand new or starting in the learning process. Great. So for those of you that are learning, I really hope that this inspires you to take a look at options as an alternative to buying stocks. Now, you're not always going to trade options, but sometimes you're going to find that they may give you a better risk to reward ratio, or they just maybe give you the right risk profile that you're looking for. Especially when markets are near all-time highs, that is usually when I like to look at options more, because as much as I want to participate in that upside, I don't want to take on that additional risk if the markets do pull back. And that's one of the things that really allows me to utilize options. And I have a second question before we start today. How many of you already have an options agreement with your bank or brokerage firm? Meaning, do you have the ability to trade options at your firm, or are you still, or have you not applied for your options account yet? I just want to get a sense here. So looks like 2/3 of you have voted already, and most of you actually have an options agreement. Perfect. So for those of you that don't have an options agreement yet, just so you know, in order to trade options with your account, you must apply for an options account first. So if you have any questions about that, please send us an email and we'll help you. We'll try to help you out with that. But chances are you have to contact your broker in order for them to open an options account for you. So again, vast number of you have an options agreement. Perfect. So this is quite suitable to what we're going to talk about here today. First, I'm going to talk about understanding stocks versus options, because before we talk about options, we should really understand what is the actual difference between the two strategies. And the best way to really learn is to compare buying a stock to buying a simple option like a call or a put, and understanding truly what is the difference between the two. Because many times when we talk about the benefits of calls and puts, it sounds really good. It sounds like, why wouldn't I want to have leverage and have limited risk? So what we want to do is we want to talk about what do you get with buying calls and puts, but also what risks are you taking when you're purchasing these strategies. Once we understand that, then we can go a little bit in depth into the more advanced strategies, because buying vertical spreads can many times give you the same advantages as buying calls and puts, but skew the risk to reward ratio even further in your favor, where you can take on even higher amounts of leverage with actually smaller amounts of risk. And that's really why vertical debit spreads are one of my favorite strategies to trade. And then lastly, in order to truly understand how these strategies perform based on when you're right on the outlook of the stock and when you're wrong, we need to explore a little bit about the option Greeks. So I'm going to talk a little bit about that, and then we're going to jump over to options play. We're going to look at some examples. I'm going to even give everyone the opportunity to submit some symbols, whether you're bullish or bearish on those symbols, and we'll take a look at some examples together at the very end. Because again, I think the best way to learn is to look at real examples of stocks or ETFs that you guys are looking to trade, and seeing how the tool helps you analyze those trades and decide whether an option strategy is suitable. So first off, let's talk about stock trading. Most of you, I'm guessing everyone here, is familiar with stock trading. The good thing about stock trading is that it's simple, really easy to understand. You have two strategies. You can either buy the stock or you can short the stock. And which one you choose depends on whether you're bullish or bearish on that stock. You would buy the stock if you're bullish, you would short the stock if you're bearish. Now, one of the hallmarks of this strategy is the fact that you get immediate gains if you call the direction of that stock correctly. What do I mean by that? If you buy a stock and the stock moves up even by a little bit, even a penny, you will start making money on that trade. Now, the more the stock rises, the more money you make. So, one of the things that you'll be able to do here is be able to trade directional exposure in an underlying stock. However, if you're wrong on the direction and you buy the stock and the stock moves down by a penny or a dollar or a crown, the more the further the stock goes, the lower or the more money you lose. So this is what we call symmetrical exposure, dollar for dollar exposure. Now, one of the great things about stock trading, though, is that you can buy or short a stock and practically hold on to it for as long as you would like to, meaning there's no expiration date. You can, as long as you have enough margin to hold on to a short, or as long as you have enough cash to hold on to a long stock, you can hang on to that trade for as long as you want. Now, there is one limitation to stock trading, is that if you felt that a stock was not going to move very much, you felt that the stock was going to stay relatively stable, maybe you feel that the stock is going to trade in a relatively short range, there's really not a lot of options for you to trade that as a stock investor. So those are some of the limitations, if you will, but the benefits of trading stocks. And I think this is not new for anyone here. I'm pretty sure everyone here is probably familiar with the concept of stock trading. So let's now put this in the context of options trading. So what I have here is an example. I have a stock that's currently trading at 100 crowns, and I'm bullish on this stock. I think this stock is going to go higher. So what can you do? As an options investor, first thing I can do, or the simplest option strategy that I can trade, is I can buy a call option. Now, how many of you are familiar with the concept of a call option? If you are, please type yes. If you're brand new to call option, please type no into the chat window. And I just got a note from Alessandro, and I apologize for this, but the live event next week is actually on Tuesday, December 10th. I apologize. I got the date correct, but I got the day of the week incorrect. So that would be Tuesday, December 10th, not Thursday, December 10th. I apologize. Okay, great. Almost every single one of you have said that you are familiar with a call option. So in this particular case, I'm going to give you a very simple example. We're going to buy a 100 crown call option, and let's say we pay 4 crowns for this call option. So I'm going to buy an at-the-money call, and let's say this call option cost me 4 crowns. So right off the bat, what you're going to see is that you're applying leverage to this trade, because a call option controls 100 shares of the stock. So if I was to buy XYZ stock originally, I would have to pay 10,000 crowns. Here, I'm actually only paying 400 crowns. So the leverage that I receive on this particular trade is actually 25 to 1. 25 to 1, because I'm going to control 100 crown stock with just 4 crowns. Now, and we're going to come back to this in 1 minute. 25 to 1 leverage. So this is the leverage ratio that you'll receive when you utilize an option strategy. Now, the best part about an option is the fact that even if I'm wrong on this trade, I have a max risk of only 4 crowns, because whatever you pay for that call option, that's the most you can lose. Now, while if I am correct on the direction of the stock and the stock rises, the further that stock rises, the more money I make. So on a call option, I get to make more and more money if I am correct on my bullish view on stock XYZ. But if I'm wrong, no matter what happens, even if the stock declines to 80 or 70 or 50, however far it goes, no matter how far it goes, the most I will lose is just 4 crowns. So this is the asymmetrical risk reward that many options traders seek. And your max reward here is unlimited. As long as the stock keeps going higher and higher, you can make more and more money. And the most you will lose is 4 crowns if the stock is at 100 crowns or lower at the expiration date. Now, so far, I think I've shown you options in a very positive light, but there is a trade-off here, right? When you get this high amount of leverage with limited amounts of risk, that all sounds really good. Why wouldn't you want that? Why would you want to take on, why wouldn't you want leverage without all of the downside? And the answer is there is one trade-off here. And the trade-off here is that this trade is really not profitable at expiration unless the stock rises to 104 crowns. So what that means is that not only do I have to be correct on the direction on stock XYZ, I actually have to be correct by a certain magnitude. And that magnitude here is 4 crowns. So the stock actually has to move 4% higher just for this strategy to break even at the expiration date. Meaning, I actually have to believe this stock is going to go up to 105, 106, 107, 108 or higher in order for it to make sense for me to trade this strategy. So if I'm bullish and the stock only goes up to 103, I can actually lose some money on this particular trade. And that is sometimes difficult to understand, but that is the trade-off that we're making when we're buying a call option. Is not only do we have to be bullish, we have to be bullish by the amount that we're paying for that call option. In this particular case, that's 4 crowns. So the stock has to move 4% higher in order for this strategy to be profitable by the expiration date. Now, if you understand, I just want to make sure everyone understands this concept. The trade-off that you're getting with the high amounts of leverage but limited risk, and the trade-off here is the fact that not only do you have to be bullish, you have to be bullish by a certain amount in order to trade this strategy. If you understand that, please type 1 into the chat window. Okay, I see a bunch of ones. Perfect. So now that we've explored this concept of asymmetrical risk, of applying leverage when you're right, but having limited risk when you're wrong, that sounds really good. But we said that the trade-off here is that you have to be fairly bullish in order for you to trade the strategy. So what I want to do is I want to explore very quickly a more advanced strategy that takes this one step further. And that's what we call a debit spread. So same example, stock XYZ trading at 100 crowns. I believe this stock is going to rise higher. And what I'm going to do is I'm going to do the exact same trade I just showed you before. I'm going to buy the same 100 crown call, and I'm going to pay 4 crowns for it. But remember, when we said previously, when we buy a call option, we have unlimited gains to the upside. So as long as the stock keeps going higher and higher and higher and higher, I will keep making more and more money. However, if you remember, a call option has an expiration date. So when we think about how bullish we are on a stock, generally speaking, if let's say I'm buying a 2-month call option on a 100 crown stock, I probably don't believe that this stock is going to go all the way up to 200 in 2 months. I maybe might think it'll only go up to 110 or 115, meaning there's a limit as far as how far I think the stock can go in the next month or 2. But when I buy a call option, I'm actually paying for all that upside. So one of the things that you can do, and this is really the power of options when you can truly harness the power of options, is you can actually sell off some of that upside. And this is something that if you're brand new to options trading, or if you're new to trading complex option strategies, this might be a little foreign to you, but just hear me out for 1 second. So instead of just paying for unlimited upside, what I can do is I can sell off some of that upside. So let's say I sell a 110 crown call, and let's say I collect 1 crown for that in terms of a credit. So this is something that you might not have thought of doing, but you actually can. And what happens is I'm basically buying for upside above 100 crowns, but what I'm going to do is I'm going to sell anything above 110 off and basically cap my gains at 110. Because in reality, I don't believe that this stock is going to go all the way to 200 or even 120. Why should I pay for all that upside? I have to pay 4 crowns for that upside. And remember, however much you pay, that's how much the stock needs to move in order for you to be profitable. So by selling that 110 crown call, there's a few things here that happens. Number 1, now my total outlay on the trade, instead of being 4 crowns, is now only 3 crowns. So right off the bat, when we first discussed the first strategy, we talked about that because we were controlling a 100 crown stock for just 4 crowns, we had a leverage ratio of 25 to 1. But when we now control 100 crowns of the same stock for 3 crowns, now what happens is we've increased our leverage ratio from 25 to 1 to 33 to 1. So now we're controlling the same 100 crown stock, but because we only have to post $3 in capital, we've increased our leverage from 25 to 1 to 25 to 1 to 33 to 1. Now, what we do here is that we are capping our max reward because I've sold off any potential gains above 110 for that 1 crown. So now, instead of having unlimited gains, I now have a max reward of just 7 crowns. Now, how do I calculate 7? That's just simply the difference between the 2 strike prices. So I bought the 100 strike price and I sold the 110 strike price. That's $10 wide. And because it only cost me $3 to trade this, the rest of that $10 is my max reward. So not only have I increased my leverage ratio on this trade, I've actually reduced my risk because no matter what happens, I can only lose 3 crowns. And on top of that, because we said that whenever we're buying an option, the stock needs to move by that amount in order for me to be profitable. And before, the stock needed to move 4% in order for this strategy to be profitable. Now, because it only cost me 3 crowns, my new break-even price is actually lowered to 103. So not only do we get higher ratio, higher leverage ratio, lower risk, but the stock actually does not need to move as far in order for this to be profitable. So before I move on, I just want to make sure everyone understands the concept of a debit spread. I know this is a lot of moving parts, and for those of you that are brand new, this might be overwhelming, but that's part of why we record these emails. We record these webinars. We make the slides available to you afterwards so that you can review these at your own pace. But if this makes sense to you, please type 2 into the chat window. Perfect. Okay, I see a lot of 2s. Great. So that, and keep in mind that we're going to come back to this concept of trading debit spreads and spreads in general in future webinars. We're going to dedicate a whole webinar just to trading debit spreads, but this is an introduction. So once we understand buying a call option and buying a call debit spread, the next 2 slides are going to be really easy because we're just going to talk about a bearish case. And this is almost the exact same thing, but now just the opposite trade. So trade a stock XYZ trading at 100 crowns. Now I'm bearish on this trade. So what can you do as a bearish investor? And this is actually one of the things that I think makes options trading a little bit more flexible than trading stocks, because you can't always short a stock, meaning you might not always be able to borrow it. The margin interest might be quite high. Versus buying a put option, you can buy a put on virtually on many of the of the fairly liquid stocks in the Nordics. So buying a put option is a much better way, in my opinion, to take a bearish view on a stock or ETF, because when you short a stock, you truly have unlimited risk. Meaning, if you short a stock and the stock rockets higher, the further it goes higher, the more you lose. Versus when you buy a put option, no matter how far it goes, you can only lose what you paid for that put option. So there's a cap as to how much you can risk. So whenever you're bearish on a trade, I always advocate that you take a look at put options instead of shorting that stock, simply because you have a max risk of what you paid for that put option. So here, 100 crown stock, I'm bearish on it. I think it's going to move lower. So let's take a look at buying an at the money put, a 100 crown put. And let's say I pay 4 crowns for that. So same thing, similar to that call option, my max risk is 4 crowns. My max reward is unlimited. Technically, it is limited, but it's really all the way down to 0. So I usually like to think of this as fairly unlimited potential reward, because you can make money all the way down to 0. The max loss here is if the stock is above 100 at expiration or higher, and your break-even price here is 96 crowns, which is 100 minus the 4 crowns you paid for that put option. So just like the call option case, now the stock needs to move 4% lower in order for this put option to be profitable at expiration. So very similar example as before, the stock needs to move about 96 crowns in order for this strategy to be profitable. So not only do you have to be bearish, you have to be bearish by at least 4 crowns by the expiration date here. So I think this should be fairly simple to understand, but I'll just ask everyone, if this makes sense to you, please type 3 into the chat window. Perfect. Okay, I see a bunch of 3s. Great, because I think this should be a fairly easy explanation. So moving on, let's just take this one step further, trading a debit spread. This is the exact same example as before, just like calls, but I'm flipping this again. 100 crown stock, I'm bearish on it. I think it's going to move lower. So what am I going to do? I'm going to buy a 100 strike put option, and at the money put, as the previous example, this cost me 4 crowns. But again, when I'm paying 4 crowns for this put option, I'm paying for the opportunity for this stock to go all the way down to 0. But most of the time, I would say 99% of the time, when I'm bearish on a stock, I don't actually believe it's going to go to 0. I think that it might go from 100 to 95 to 90, maybe 85, but I really don't think it's going to go down to 0. So why should I pay for all that downside? And the reality is you shouldn't. In many cases. There are some cases where you should, but most cases, I believe that you can get a more efficient trade by selling off some of that downside. So here what I can do is I can sell a lower put and collect some, let's say 1 crown for that. So basically I'm bearish on the stock, but I think there's a limit as to how far it can go. And what this does is it reduces my overall risk down from 4 crowns to just 3 crowns a share, which again, like in the call option example, because now I'm controlling 100 shares, a 100 crown stock with just 3 crowns, now again, my leverage goes from 25 to 1 to 33 to 1. But the trade-off that I have here is that I've capped my potential rewards. Instead of having unlimited gains like I have in the put option, now the most I can gain is 7 crowns. But I still have more than 2 to 1 risk to reward ratio on this trade, meaning if I'm correct on this trade, I'm still risking 3 crowns to potentially make 7. That's a really good risk to reward ratio in my opinion. And lastly, my break-even price improves from 96 crowns to 97 crowns. Now, again, that might not sound like a lot, but if every single trade that you make does not need to be as does not need to go as far in order for you to be profitable, I'll show you in a few seconds how much this 1 crown discount will actually reflect in terms of your total return, because that's really what everyone here is concerned about. But from my perspective, as a trader, the most important thing is actually managing risk. It's not seeing how much reward I can make, because the reward will always be there as long as I can manage risk. If I don't manage risk, then I'm at risk blowing up my account and not having enough capital to continue trading. Something that I also want to discuss with you guys on some future webinars is managing risk of options trading. But today we're here to discuss some strategies. So lastly, what I want to talk about are option Greeks. Now, option Greeks are at best confusing for most users. Now, Greeks are not easy to understand in my opinion, but what I want to do today is I don't want to put a lot of math or terminology in your head that might scare you off from options trading. So what I want to do is I want to make sure that everyone understands that when I talk about the Greeks, I just want you to understand it from a conceptual perspective. I don't need you to learn the math. I certainly don't need you to do the calculations yourself, because platforms like Options Play will actually do the calculations for you. But it's really important for you to understand what are the inputs, what changes your option pricing in order for you to truly understand what those calculations mean. So today what I want to do is I just want to give you guys a run through of the Greeks from a conceptual perspective, and then I will show you how the Options Play platform actually calculates these things. So first, we're going to start with delta. Delta is the most, in my opinion, the most important Greek to remember when you're trading options, because delta tells you the change in the option price with respect to the change in the stock price. So in the previous example, when we bought a call option on a 100 crown stock, that was trading at $4 for the 4 crowns for that option. The question most users have is, if the stock goes up by 5 crowns, how much money do I make on my options trade? And that's what delta helps you understand, is if the stock goes up by a certain amount, how much does your option price go up by? So when you have an option that has a delta of 0.5, and in the call option and at the money call option will typically have a delta very close to 0.5, what that means is that for every one crown that the stock moves up or down by, your option price will increase or decrease by about half a crown. So what that means is that in that 100 crown example, if the stock goes from 100 to 101, that's a 1 crown increase. Your option will move by 50 cents. So that 4 crown option will be now worth 4.5 crowns. So I just want to make sure everyone understands that. Delta shows you the change in the option price with respect to the change in the stock price. Vice versa, if you bought that call option and the stock went from 100 to 99, now your 4 crown option is now only worth 3.5 crowns. Does that concept make sense to everyone? If that makes sense, please type 4 into the chat window. Perfect. See a lot of 4s. Great. Now, keep in mind that this is assuming that everything else is held constant. So whenever we talk about the Greeks, we're assuming that the only thing that changes here is the stock price, nothing else, okay? Because, and this is really where the complexity comes into, because other things do change. So we need to also understand what other things affect the stock price, and that's where the next couple of things come in. So theta, because options have an expiration date, what you'll see is that an option price will actually decay as you get closer to expiration. So I'm not going to spend too much time on this today, but and I will spend more time on this on future webinars. But one of the things that you'll see on an option curve is that if you have time here at the bottom and you have a price of an option here, what you'll see is that the price of an option will actually start to decrease as you get closer and closer to expiration. And this is a bit of a curve, meaning it's not a straight line. It curves down like this. And what you're seeing is the decay of an option, because options have an expiration date, and as it approaches the expiration date, it actually decreases in value. And the question is, how much does it decrease by? And that's what theta tells us. Theta tells us the change in the price of the option with respect to the change in time. So if you see a call option that has a theta of 0.5, what that means is that this option will decrease by 0.05 crowns per day. So in the example before, we said if we have a 4 crown option that's trading at $100 and the stock increases by 1 crown, that option is now worth 4.5 crowns. But let's say it takes a week for the stock to move 1 crown. So what you have to do is you have to factor into the fact that the option increased by half a crown, and then you also have to factor in the fact that it lost 0.05 crowns per day. So 0.35 crowns over the next week. So what you net out between the two is that you've made half a crown on the delta, but you lost 0.35 crowns on time. So your net is you're up about 0.15 crowns. So this starts to get a little complex, right? Because you have to now factor into the fact that the stock is moving, but also time is going on. But this is some of the things that we're going to really explore in the next few weeks, in the next few months, is how does this really affect where you buy your options? So as of right now, I haven't talked about how to pick expiration dates, how to pick strike prices, because those are things we're going to get into when we talk about specific strategies. But these delta and theta really affect when you should, what expiration dates should you choose when you're buying options, what expirations should you choose when you're selling options, and vice versa. What strike prices should you buy and what strike prices should you sell? But it's really important to understand these concepts before we explore those types of best practices. So it's important to understand, in my opinion, delta and theta are the two most important Greeks to remember, because those are the two things that have the largest impact on the actual price of your option. So you have to factor the fact that you expect the stock to move in your favor. Delta helps you with that, but also if it takes a long time to happen, theta starts to work against you if you're buying an option, but theta works in your favor if you're selling an option. So that's something we'll cover, as we learn more about options in the next few weeks and months. I just want to show you guys what's to come. Lastly, gamma. Gamma is actually what we're buying when we're buying an option. So when we talk about buying a call option or a put option or even the debit spreads that I showed you today, what we're really buying is gamma. Gamma is what provides us this asymmetrical risk that I'm talking about. What is asymmetrical risk? It means that if I'm right, I make more and more and more money. But if I'm wrong, I actually lose a limited amount of money. And that all comes down to gamma. And I'll explain this here in 1 second. What gamma actually tells us is the change in delta with respect to the change in stock price. So above here, I talked about the call option having a delta of 0.5. And I said that if the stock moved up by 1 crown, your option will move up by half a crown. If the option went down by a crown, if the stock moved down by a crown, your option loses half a crown. But what happens is, when it goes from 100 to 101, and then it goes from 101 to 102, the delta actually starts to increase. So what happens is, as you're correct on the trade and the stock goes higher and higher and higher, the delta actually also gets higher and higher and higher. And eventually what happens is the delta approaches 1. And when delta approaches 1, you get dollar for dollar exposure. That's why the P&L chart of a call option looks something like this, because that's exactly the payoff that you get with a stock, right? Dollar for dollar exposure as you go higher. But when you're wrong, you get almost 0 on the dollar when you're wrong. So when the stock moves lower, instead of losing more and more money like a stock, you actually have a flat like this. So what happens is gamma changes delta when it goes in your favor. It makes it higher and higher and higher. But when you get the direction wrong, it actually decreases delta. So when you go from 100 to 99, you might lose half a crown for every dollar. But when you go from 99 to 98, you're actually losing less than half a crown. You're actually losing about 0.43 of a crown, because gamma shows us how much delta changes by. So as the stock goes in our favor, delta keeps getting higher and higher and higher. That's how we're getting the leverage and getting dollar for dollar exposure. But when we're wrong, we're actually losing less and less money per $1 the stock moves against you. Now, this is, I will admit, this is a difficult thing to wrap your head around. But I don't need you to understand the math behind it. I just need you to understand the concept that delta changes. When it goes in your favor, you get more and more money. And when you're wrong on the trade, you actually lose less and less money for every dollar the stock goes against you versus every dollar that the stock goes in your favor. And I just want to make sure everyone understands that concept. And if you don't, it's okay. This is something that takes time to learn. But if any of you understand that, please type 5 into the chat window. I know I spent a little bit of time on this, but I want to spend the time on this because it's really important to understand what actually affects your option price. And these 3 Greeks are, in my opinion, the most important Greeks to understand. And you don't have to understand them from a math perspective. You just have to understand them from a conceptual perspective. So great, I see a lot of 5s, which is perfect. And again, if you feel that this is a little over your head or this is a little confusing, that's okay. This is something we'll come back and explore these concepts over the next few weeks. So with that, what I want to do is I want to jump over to options play, because I think the best way for us to actually learn what I taught you here today is to show you some real examples. So I'm going to go through one example, but while I do that, you guys can submit some symbols that you want us to take a look at. When you submit those symbols, please type whether you're bullish or bearish on that symbol. And what we'll do is we'll take a look at some of these symbols together, and we'll show you how we can utilize options play to seek some, to compare buying a stock to buying a call option to buying a call spread. So while I look at Novo Nordisk pharmaceutical stock, again, please type into the chat window any symbols that you might want to take a look at, preferably Swedish, Swedish, Danish, or Finnish equities that have options listed on them, and just tell me whether you're bullish and bearish, and we'll take a look at them after I finish this one example. So this stock is, in my opinion, a really good example of when an option strategy might make sense. And what I mean by that is this is a very strong stock that's trading near its 52-week high. It's trading near its highs. So I might still continue to be bullish on the stock, but there's quite a bit of risk here from a risk to reward ratio that this stock just pulls back, right? It really recently pulled back to this 364, 363 level, and it's currently trading at 385. So maybe I think that even though I'm bullish on the stock, there's a high amount of risk that I do see a pullback here towards the end of the year, and I'm concerned about that. So one of the ways to offset that risk is to buy an option, because an option allows me to take a bullish or bullish view on the stock, but limit my downside losses. So let's take a look at this. Buying 100 shares of this stock, 38,000 crowns. Buying a call option, 1,400 crowns. And here I'm buying a January 17th, which is roughly about 45 days from today, 380 crown call option, which is just the at the money call option. The current stock is 385. This is a 380 call. Now, remember, when we talked about this, buying the call option gives me unlimited upside, right? Meaning I think this stock can go to 400, 450, 500, and further. But reality is there's an expiration date on this, January 17th. So chances are I may not think that the stock is going to go all the way up to 500 by January 17th. So what Options Play does is it not only selects the debit spread for you, but it automatically selects a strike price that generally makes sense to give up upside above. What do I mean by that? So here we've automatically chosen the 410 strike. So why did we choose 410? It's because the 410 strike, or the 410 strike price, has roughly only about a 15% chance that the stock is going to go above 410 by expiration. And this is based on the price of the options. We derive these probabilities based on the implied volatility of an option. And what we're doing is we're basically saying there's a relatively low chance that the stock will go above 410. Even if it goes a little bit above, you'll see that this strategy still outperforms, and I'll show you that in 1 second. But when I sold this a 410 call, instead of paying 1,400 crowns for the call option, I'm collecting 2.05 crowns to sell the 410 call. And what that does is it reduces my overall cost on the trade by about 2 crowns per share. So instead of 1,400 crowns, it's only 11.95. So that 200 crown savings, what I'm going to do is I'm going to show you what the trade-off is here. So this stock's trading at 385. Maybe I think the stock is going to break back above its 52-week high and move a little higher. Maybe let's just conservatively say that I think the stock can go up to 405 by the January expiration date. So what we want to do is we want to show you how these strategies perform. And that's why we created a P&L simulator, because many times if you look at a page that looks like this and you're choosing expiration dates and strike prices off an option chain, it's difficult to know if I'm right, how much money do I make, or how much money do I lose if I'm wrong. And that's why we created the P&L simulator. And before we talked about delta, theta, and delta and theta, and that's what this price slider does. Is it takes where you think the stock is going to go, it takes the delta and the gamma of that option and calculates roughly how much money you would make on that move. So you can actually use these sliders to see how time and the price of the stock affects the price of the option. So in this particular case, if the stock rises to 405 by the expiration date, if you were a stock investor, you would make a 5% return. If you bought a call option, you would make a 78% return because you only posted 1,400 crowns and you made a 1,100 crown profit, which is a 78% return on your capital. But as you can see here, when you only have to put up 1,195 crowns to place this trade, you can make an additional 1,305 crowns. That boosts your returns from 78% to 109%. That is the type of increase in reward that you can potentially see on these types of debit spreads. And more importantly, like I said before, my concern is that this stock pulls back to this recent low, 363, 362. If this stock does pull back, and I think that there's a fair probability that that might happen, as you can see, as a stock investor, I would lose 2,300 crowns. versus only 1,400 crowns on my call option versus only 1,100 or 1,200 crowns on my call spread. So not only do I make a higher return on the right-hand side using the call spread, I actually risk the least amount of money on this particular trade. And that's really the type of asymmetrical trade-off that we're really looking for when we're utilizing options. Now, I still want to make sure that everyone understands what is the trade-off here, right? Why wouldn't I trade this all the time? And the answer is because you actually need to, for this to be right, not only based on direction, but also based on magnitude. So this stock's at 385 right now. You can be bullish on this stock, and let's say the stock goes up to $390. So you got the direction correct. But as you can see here, if you had bought the stock, you would make a 1.2% return. But if you bought the call option or the call spread, you would actually lose money. And this is where I think a lot of beginners tend to get a little confused with options trading, is how can I get the direction correct and still lose money when I buy a call option? And this comes back to what I said before. What you pay for that call option, you need to overcome that amount in order for it to be profitable. So if it only goes up a little bit, you're likely still actually going to lose money. And that sometimes can be frustrating of buying a call option. The stock goes higher and then you lose money. But this is the trade-off that you have when you're trading these types of strategies, is that not only do you have to get the direction correct, you also have to get a fair enough of a move in one direction. So here, as you can see, this has to go from 385 to, let's say, maybe 395. Yeah, so about 395, now you start making some money. So this stock needs to move about 10 crowns higher in order for this strategy to make money. Now, in my opinion, that's not a big move, right? This stock can move 10 crowns very easily. It moves 10 crowns in just a few days. But again, you need to have this 10 crown move just for you to break even on this particular trade. So you really need a bigger move, 400, 405, in order for you to make a significant amount of profit for this trade. So I want to make sure everyone understands the trade-off here, okay? Now, let's go through a couple of examples now. Looks like someone wanted to look at H&M and they're bullish on it. So let's take a look at H&M. Trading at 191 crowns or 191 crowns. Let's say we believe that this stock is going to rally back up to its 52-week high around 208 or so. Great. So let's take a look at that. So this reports earnings on January 30th, which is okay. So we're looking at buying 100 shares of this stock, which is 19,000 crowns, 790 crowns to buy a January 190 call option, which is the at-the-money call option. Or, like I said, when we're buying a call option, we're buying unlimited upside, right? So maybe you don't think it's going to go to 220, 250. So why pay for all of that? Here, we're going to sell the 210 call against it. And what that does is it reduces my cost from 790 crowns down to 690 crowns, 695 crowns. So almost a 100 crown reduction in my risk, a 100 crown reduction in the amount of capital that I need to trade this particular trade. So let's say I believe this stock can go back up to its 52-week high around 205 or so. As you can see here, even if the stock rises back up to its 52-week high, you're looking at a 1,400 crown, 7.5% return on the stock, which is actually a pretty good return, in my opinion, on the stock in just about 45 days. But as you can see here on the call option, an 89% return. So more than 10 times leverage on this particular trade. Vice versa, the call spread, because it only cost me $695 instead of $790 to take the same bullish trade, that magnifies my return even further, because we talked about when you're trading a call spread, you get higher amounts of leverage. So if the stock does go in your favor by the same amount, you're going to make a higher return. So instead of 89% return, you're looking at 115% return. So those are the types of increases in returns that you should expect. And if let's say H&M declines to 176, I don't know, for those of you that are very, very astute technical analysts, you might notice that this looks a little bit like a head and shoulders formation, you know, that maybe you get a pullback down to 167. Now, I would certainly say that that's more of a bear case, but and I think that's more of an extreme case, but let's say you do get this head and shoulders formation, the stock pulls back to its neckline around 167. That's a 12.5% loss, a 2,300 crown loss on the stock. only a 790 crown loss on the call, 695 crown loss on the call spread. So least amount of risk here. But again, keep in mind, you can get the direction correct, but if the magnitude's not large enough, so let's say the stock goes up to 196, goes up 5 crowns, you still lose money on the call and the call spread. Not a lot, but you still lose money versus you would have made 2.77% return on the stock. So you have to ask yourself, am I not only do you have to be bullish, you have to be bullish by a certain amount. And you can actually use our tool to better understand, well, exactly how far does the stock need to go? The other thing you can also think about is, here, I've sold the 210 call. Maybe you think maybe you're really bullish on the stock and you think the stock can go, right? Maybe you think it can go to 212, right? So as you can see, even at 212, this strategy still outperforms because you get a higher amount of leverage. It outperforms all the way up to about 213 or so, and that's when the call option starts to take over. So you can really ask yourself, am I really bullish on this stock? Do I think the stock's going to go above 213 by January 17th? If you do think it's going to go above 213.5, then you should just buy a call option. Pay for that unlimited upside because you actually think it can go there. If you don't think it'll go there, you're better off perhaps looking at a call spread. So I'm already a few minutes over time, but I actually do want to address this one last question. Peter wanted to look at a bearish example. I do want to show you guys a bearish example here. Ericsson B. Peter wanted to look at Ericsson B. He's bearish on this stock. I don't personally have much of a view on this stock from a technical perspective. It does seems to, it has traded in this fairly consolidated period for some time between 84 and 90 roughly or so. It's near the top of that range. But let's say you're bearish on this, and this is really where options play can come into play. You can use I'm bullish and look at 3 bullish strategies, or you can select I'm bearish and take a look at 3 bearish strategies. I hope that this is a good example to look at. So sure, you certainly can short 100 shares of this stock, but again, I never recommend that because shorting a stock truly opens you up for unlimited risk. And there's always the chance that you're wrong, and I want to make sure that when you're wrong, you don't expose yourself too heavily. Buying a put option is a much better way, in my opinion, to take a bearish view with limited risk so that if you're wrong, you only risk the 335 crowns here in this particular case, or you can buy a put spread. So this is an 87.5 put at a stock that's currently trading at 86 crowns. So here what we're doing is we're also buying the 87.5 put, but because again, I don't really, if you're bearish on this trade, there's probably a limit as to how far you think the stock can go. So $80 is 80 crowns is all the way down here. It's a pretty significant move to the downside. It was here in early October. So what we're saying here is we think that it's reasonable to sell an 80 crown put against the 87.5 crowns. So instead of paying 335 crowns, you collect 45 cents on this, and now it only costs you 290 crowns. And now let's take a look at how does this strategy perform. So if the stock declines to 80 crowns, which is a pretty big move to the downside, maybe let's start with a more conservative downside, maybe around this 84 support level here. So let's say we think the stock declines to 84. Notice how, as you can see here, at 84 crowns, it's not very attractive in my opinion. You get a 3.2% return on the stock, only a 4.48% return on the put. So you're barely making money on this put. So this is the minimum that you need to believe the stock is going to move down by in order for it to make sense to even buy a put. The put spread is a little better. It makes a 20% return. In my opinion, this is not a strong enough case to really go short if you think the stock is going to decline to 84 crowns, right? Not a big move from 86 to 84. But if you think that this stock can move significantly lower to, let's say, 80, because if this thing breaks below 84, I think you can easily get to about 81 here, which is a major support level below. Here, if you can get it down to 80, a 6.6% return on the stock, 94% return on the put, 124% return on the put spread. So again, very attractive if you do think that this can get back down to 81. The trends have started turning positive here, so I don't particularly like trading against the trend, and it's started to trend bullish, for quite a few months now. since mid-October, right? And we're getting higher lows. This is typical of more of a bullish outlook in my opinion. But again, if you are contrarian, Peter, and you want to utilize this tool, our tool is really designed to allow any stock. You can select I'm bullish and see 3 bullish strategies, or select I'm bearish and see 3 bearish strategies very, very quickly. So with that concludes what I wanted to show you here today. I really hope that this was helpful for those of you that are in the process for learning options, and even for those of you that are experienced in trading options, showing you this tool that can maybe help you better analyze your strategies and show you how you can utilize tools like this to make better decisions in your options trades, and hopefully just make your options trading analysis a little easier. Because I know when you use pages that look like this, it's difficult sometimes to know where to start, what strategy, what expiration date, what strike price. And even if you know all those things, how do you analyze these appropriately based on where you think the stock's going to go? So we really created this to make that process as easy as possible for you. So I hope that I'm able to show you this. And again, this is just the beginning of our education together. I'm here to really help you guys, provide you with the continuing education that you likely will need to continue trading options. We're here to provide you with the tools, the education, the support. So at this point, what I'll do is I'll open this up for questions. I know there are a few questions already that were posted, so I'll answer those questions, but please type any questions you have into the chat window, and I'll answer as many questions as I have time for here today. So Frederica is asking for, could you please explain the options play score? Great question. I was going to get to that, but I didn't get a chance today. So the question was, what is the options play score? The options play score is really trying to take a look at what is the potential risk versus reward on each strategy if the stock was to trade within a reasonable range. And what I mean by that is the options play score assumes that there's an equal probability of the stock moving higher and the stock moving lower. So it doesn't have a directional view on the markets. And what it's saying is, well, if there's an equal chance of the market moving higher or lower, what is the maximum risk that I have on a strategy, and what is the maximum reward? And it weights the two by the actual probability of losing money on this trade versus making money on that trade. And it really gives you a score. And the reason we created this was because on many strategies, you can calculate risk to reward, or you can't calculate risk to reward on something like a call option, something that has unlimited reward. How do you calculate risk to reward? So what we did is we basically said, there's a decent range that the stock can trade in. Let's look at what are the risk to rewards within that range, and let's help you compare each strategy's risk to reward and show you side by side which one has the best risk to reward. So here, as you can see here, I'm risking 365 just to make 385. That's not a very good risk to reward, in my opinion, for a call spread, especially when you have only about a 38% probability of making the reward and about maybe a 60% chance of losing 365. That's not a great risk to reward. That's why it has a poor options play score. Versus here, I'm risking 290 to make 460, and I have about a 40% chance of making 460 and maybe a 60% chance of losing 290. That's a much better risk reward, and that's why it's got a score of 100. So that's why we created this options play score, because what I just walked you through is difficult to do those calculations on your own. And you have to look at each one individually, look at how much you're risking, how much potential reward, and then figure out the probabilities. It's a lot of math. So we created this tool to do the math for you, and we color code it for you so that you know green is good risk reward, yellow is average, and red is poor risk reward. So this helps you better understand the risk of a trade before you get into one, because many times when you're looking at a page that looks like this, it's really difficult to understand the risk to reward of a call option that costs 4.9 crowns, right? How do you know what the risk is? And it's really difficult to do that. Or how expensive is that call? So we created the options play score to give you a better sense for that. So I hope that answered your question. Peter, thank you so much. I really appreciate it, and I hope to see you on Tuesday as well. I hope to meet you. Per Annie, thank you so much. I really appreciate that as well. Any other questions And again, just to remind everyone, if you don't have access to Options Play yet, you can sign up at optionsplay.se, which I just posted into the chat window. And again, I hope to see those of you here this upcoming Tuesday, not Thursday. Thank you, Alessandro. You can sign up for this free event coming up Tuesday, December 10th, 5:30 to 7:30 p.m. At the NASDAQ. It's a free event. There will be 4 speakers, if I'm not mistaken, and a panel to help you guys better understand how, the different tools and resources that are available to you here in the Nordics to help you trade options. I'll give a presentation on options play, and we'll have a little question and answer at the end. So I hope to see you guys there. Any other questions before I sign off for today? Per Aning, thank you so much. I will see you there as well. I hope I pronounced your name correctly. If I didn't, I apologize. So I hope to see you guys here this upcoming Tuesday. Otherwise, our next webinar is going to be next Thursday. I will be back next Thursday to do another webinar. Again, we're here to help you with ongoing education. This is not just a one-time event that we're doing. I hope to see, I already recognize some of the names from last time, so thank you so much. And we do have a special webinar tomorrow. For those of you that just want to learn a little bit more about the platform itself, we're not going to talk about option strategies. We're just going to give you a walkthrough of the platform. Please look out for an email. We will send out an email on registering for that webinar. It'll be tomorrow at 1 p.m. Stockholm time. It's just a special webinar, and if you can't make it, don't worry. We're going to record it and we're going to send it out to everyone. We just want to give everyone a walkthrough of the platform as well. So I hope to see some of you there tomorrow. If not, I will see you on Tuesday or on Thursday for the next webinar. Have a great evening, and I'll see you guys next week.